Everyone is talking about this right now. A new $25,000 tax break on tips. Sounds like free money. Sounds simple. Sounds like anyone earning tips can benefit. But here's the reality. Most people hearing this either don't qualify or are about to use it completely wrong. And that's where the real risk is. Not missing the deduction, but claiming it when you shouldn't.
Wait, so this isn't just no tax on tips like people are saying online?
Exactly. That phrase sounds great, but tax law is never that simple. Because the headline is simple, but the rules behind it are not. Welcome to Ivy Smart Tax. This is our tax update series where we don't just repeat headlines, we break down what actually applies to you.
So this is not how much can I get? It's more like, do I even qualify?
Exactly. Because misunderstanding this can affect your tax return, your refund, and even your risk. Let's make this simple, because this is where most people get it wrong. Before you think about the $25,000, you need to ask one question. Does this even apply to me?
Yeah, that's exactly what I'm thinking right now. Like, how do I know if I qualify?
Here's a quick reality check. Ask yourself, do you receive tips directly from customers? Is it tied to a service-based role? Is that income actually reported properly? And is your income within the allowed range? If most of your answers are no, this likely does not apply to you.
So right away, a lot of people are already out?
Yes, because this deduction is not for all extra income, only qualified tips. And that word qualified is where everything changes.
So it's not about how much you earn, it's about what type of income it is?
Exactly. And if the classification is wrong, the deduction doesn't apply at all. Now, here's where most people get confused, and this is a big one. When people hear tips, they think Uber, DoorDash, freelancers, basically any extra money from customers.
Yeah, anything customers add on top.
That's how it feels in real life. But from a tax perspective, that assumption is not always correct.
So just because it feels like a tip doesn't mean it's treated like one?
Correct. Because the IRS doesn't ask what you call it. It asks, how was it paid? How was it reported? What's the working relationship? And based on that, something people call a tip may not qualify at all.
So two people can both get extra money, but only one actually qualifies?
Exactly. Because under IRS rules, tip income is generally voluntary, paid by customers, and reported through an employer system. If that structure isn't there, the treatment changes. Now we get to the most important distinction in this entire rule, W-2 versus 1099. And this is where most people oversimplify.
Yeah, I've heard people say W-2 works, 1099 doesn't.
That's the assumption, but it's not that simple. The reality is both can qualify, but they're evaluated under completely different rules.
So it's not about one being right and the other being wrong?
Exactly. A W-2 employee operates inside an employer system with payroll, reporting, and structure. A 1099 individual operates as their own business, and once that structure changes, the tax rules change with it.
So the same type of income can lead to completely different outcomes?
Yes, because in tax, structure drives the result, not just the income itself. Now let's zoom in on W-2 income, because this is where a lot of people start to feel confident. If you're an employee, your tips are usually reported through payroll, included on your W-2, tracked by your employer.
So that sounds like the clean case, right?
It's definitely more transparent, but here's the key point. Transparency does not mean eligibility. Just because your W-2 shows tip income doesn't mean those tips qualify for this deduction.
Wait, so even if it's reported correctly, it still might not count?
Exactly. You still have to meet the definition of qualified tips, the type of occupation, and other conditions.
So W-2 just makes it easier for the IRS to see, but doesn't guarantee anything?
Correct. It gives visibility, but not automatic approval. Now, let's talk about self-employed income, because this is where a lot of people get it wrong. Many people assume, if I'm 1099, I'm out. But that's not always true.
Wait, so self-employed people might still qualify?
Possibly, but the rules are stricter. Self-employed income is usually reported on Schedule C, and it's subject to self-employment tax, up to about 15.3%.
So it's already a completely different system.
Exactly. Now, here's the key limitation. Your deduction cannot exceed your net business income.
So if I make $20,000 in tips, but only net $5,000,
Then you're limited to $5,000. You can't create a loss just to claim the deduction.
so this isn't a loophole situation.
Not at all. And one more thing people misunderstand. This reduces income tax, but it does not eliminate self-employment tax.
So no tax on tips is not literally true?
Exactly. It's a simplified message, not the full tax reality. Now let's talk about the number that's getting everyone excited. $25,000. Because this is where most people completely misunderstand the benefit.
Yeah, when I first heard it, I thought, wow, that's a huge tax break.
That's exactly how it's being presented. It sounds like you get $25,000 back. You don't pay tax on $25,000. But that's not what's happening.
So what does it actually mean?
It's a deduction, not a payment. So your actual savings depends on your tax rate. For example, if you deduct $10,000 and you're in a 30% tax bracket, you're not saving $10,000. You're saving about $3,000.
That's a big difference.
A huge difference. And here's what most people don't realize. $25,000 is a maximum cap, not a guaranteed amount, not automatic, and not for everyone.
So hearing $25,000 doesn't mean you actually get $25,000.
Exactly. It depends on how much qualified tip income you actually have, your total income level, and whether you're within the phase-out range.
So for a lot of people, the real benefit is much smaller?
Yes, and for some people, it may be zero. Now, here's where this gets more serious. This deduction is not based on one rule. It only works when multiple conditions line up.
So it's not just, I have tips, so I qualify?
Exactly. Think of it as a checklist. Is it qualified tip income? Is your occupation eligible? Is the income properly reported? Are you within the income limits? If one of these is off, the entire position can fall apart.
So the IRS isn't looking at just one piece?
They're looking for consistency across everything. Now, let's make this real, because this is the part everyone is waiting for. Let's look at actual situations and how this might apply.
Yeah. This is what I want to know. Like, where do I fall?
Let's start with a restaurant server. Receives tips directly from customers. Works as a W-2 employee. Income is reported through payroll. That type of situation is more likely to qualify.
Okay, that makes sense.
Now let's look at a salon employee. Also receives tips. Also in a structured system. That may qualify as well, depending on reporting.
What about something like Uber?
That's where things change. Even though it feels like tips, it's often treated differently for tax purposes. So in many cases, it may not qualify the same way.
And freelancers?
If you're a freelancer and clients give you extra money, that's usually considered business income, not qualified tip income.
So two people can both get extra money, but only one qualifies?
Exactly. And that's why this deduction is much more limited than people think. Now we move into something a lot of people overlook: documentation. Because in tax, it's not enough to say something qualifies. You have to be able to prove it.
So it's not just about having the income?
Exactly. The IRS is not just looking at numbers, it's looking at the story behind the numbers.
What kind of proof are we talking about?
You need to be able to support how the income was earned, why it qualifies as tip income, how it was reported, and how it connects to your work.
So weak records equals weak position?
In many cases, yes, because if something isn't clearly documented, it becomes very difficult to defend.
So this isn't just about getting the deduction, it's about being able to support it later?
Exactly. The numbers alone are not enough. The explanation behind them has to hold together. Now, here's what I'm already seeing, and this is happening right now. People are moving too fast without understanding how the rule actually works.
Yeah, this feels like where people get into trouble.
Exactly. The biggest mistakes are simple: assuming all tips qualify, treating 1099 or business income as tip income, thinking the $25,000 is automatic, and rushing to amend returns immediately. They hear a big number and jump straight to action.
So the issue isn't missing the deduction.
It's using it incorrectly, and that's where risk shows up.
What about people who already filed?
Same principle. Don't rush. Hearing a new rule doesn't mean you should immediately change your return. Start with evaluation. Do you actually have qualified tip income? Was it reported correctly? Does this rule even apply to you? Because if it doesn't, amending won't help.
So not act fast, but check first?
Exactly. Understand first, then decide. So here's the bottom line: this is not about chasing a $25,000 deduction. It's about understanding whether your situation actually supports it.
So it's not how do I get it? It's do I even qualify?
Exactly. Because the biggest mistake I see is not missing a tax benefit. It's assuming something applies when it doesn't. If you want to understand how tax rules actually apply to you, not just what sounds good online, follow Ivy Smart Tax. I break down what works, what doesn't, and what you need to watch out for, so you don't make decisions based on headlines. And if this helped clarify things for you, leave a comment with your situation or share this with someone who might need it, because a lot of people are getting this one wrong right now. This content is for general informational purposes only. This is not personalized tax advice, and this deduction may not apply to your specific situation.